All right, today we're tackling a huge topic. I mean, this is something that powers our entire world, from the phone you're holding to the biggest companies on the planet. So let's dive into the fascinating engine of growth we call capital markets.
So, let's kick things off with a massive question. Imagine you've got this absolutely revolutionary idea, right? But to get it off the ground, you need a ton of cash. We're talking, say, $50 million. Where in the world does that kind of money even come from?
Well, the answer is right here. It's through the power of this incredible system we're talking about today. This is the place where ambition meets investment and where brilliant ideas become reality.
So how does this whole thing actually work? Well, at its very core, it's a pretty simple dynamic between two key groups of people. You've got those who have money and those who need it.
It's really that straightforward. On one side, you have savers. These could be people, institutions, you name it, with extra cash they want to put to work. And on the other side, you've got the spenders. Think entrepreneurs or big companies who need that cash to build, expand, and innovate. Capital markets, they're just the essential bridge that brings these two sides together.
Okay, so how do the spenders actually get their hands on the money? One of the most common ways is surprisingly simple. They basically take out a loan. But, and this is key, it's not from a bank in the way you might be thinking.
And that, my friends, is exactly what a bond is. When you buy a company's bond, you are literally lending them your money. You're the lender. In return, they promise to pay you back the full amount plus some extra payments for your trouble, and that's what we call interest.
To really nail this down, let's use a real-world example with a company we all know. Let's say you decide to buy a $10,000 bond directly from Disney.
So that 10 grand is your principal. That's the initial cash you're handing over. Now, Disney can take that money and use it to build, I don't know, a spectacular new ride for one of their theme parks.
So what's in it for you, right? Well, that's the interest. In our example, it's 5% a year. This is your reward for lending them your money, for putting it to work instead of just letting it sit around.
And doing the quick math, that 5% interest on your $10,000 investment translates to $500 in your pocket from Disney every single year that this bond is active. Not bad.
And then finally, at the end of the loan term, let's call it 5 years, the bond matures. This is just a fancy word that means Disney gives you your original $10,000 back. So, over those 5 years, you've collected all those interest payments, and you get your entire initial investment back at the end. That sounds pretty great, doesn't it? A steady income, your money back, but it brings up a really important question. Is a loan to some brand new, unproven tech startup just as safe as a loan to a global giant like Disney? The answer, of course, is no. And that difference is absolutely crucial.
And that's exactly where risk ratings come in. The best way to think about them is like a financial report card for a company. Bonds that get an A or AA rating are called investment grade, which means they're considered super safe. Now, as you go down the scale, the risk that the company might not pay you back goes up. And to make up for that higher risk, these riskier bonds, sometimes called junk bonds, have to offer you a much, much higher interest.
So, bonds are a super powerful tool, but at the end of the day, they're loans. The other major way companies raise money is totally different. See, if bonds are all about being a lender, stocks are about becoming an owner. Here's the critical difference. When you buy a stock, which is also called equity, you're actually buying a tiny piece of the company itself. You become a part owner. The company gets your cash, and here's the kicker, they don't ever have to pay it back. Now, your fortunes are tied. If the company does well, the value of your little slice of ownership can grow right along with it.
So how does a company go about selling these little slices of ownership? Well, there are two main paths they can take. The first way is a public offering. This is where the company sells its shares on the open market to pretty much anyone. You, me, your neighbor. The second way is called a private placement. This is way more exclusive. It's where shares are sold directly to a hand-picked group of large, sophisticated investors. Think of a venture capital firm that specializes in bankrolling young, high-growth companies.
And this brings us to another key idea, the primary versus the secondary market. The primary market is where a company sells its shares for the very first time. This is called an initial public offering, or an IPO. The best analogy is buying a brand new car, fresh from the factory. After that first sale, all the trading of those shares happens on the secondary market. Think the New York Stock Exchange. That's basically the used car market, where investors are just buying and selling from each other.
Okay, time for a quick knowledge check. Let's say a big company, one that's already on the stock market, decides it wants to sell even more shares to fund a new project. What do we call that? Is it A, B, C, or D? And the correct answer is C, a seasoned equity offering. If you got that, nice work. The key word here is seasoned. The company is already established, it's already trading on the public markets. It's not their first time at the rodeo, so it can't be an IPO. It's an additional offering of stock.
So we've covered bonds as loans and stocks as ownership. But let's zoom all the way out. Why does any of this matter? Why are these markets so incredibly important to all of our lives?
Well, it really just boils down to this one simple but really profound idea. Capital markets keep the global economy moving. Seriously, without this constant flow of money from those who have it to those who can use it to build things, everything would just grind to a halt. So when you boil it all down, capital markets are the essential engine connecting wealth to innovation. They take the savings of millions of people and they channel that money directly to the entrepreneurs and the companies with the next big ideas. And that connection is what fuels the economic progress that benefits every single one of us.
So, we'll leave you with this final thought. Now that you get the difference between being a lender and being an owner, you understand the fundamental choice that every single investor has to make. So when it comes to your own savings, what would you prioritize? The relative safety and the predictable income of a bond? Or the unlimited growth potential and, the higher risk of a stock? That's really the central question at the heart of all investing.